For 17 years, I was a public markets investor in stocks and bonds. And during that time, I thought a lot about risk. And I had the opportunity to travel around the world, meet with Fortune 500 CEOs and CFOs to dig into their business and also think about risk from not only their business, but our investment in their business. So let's dig into my framework on risk for business owners considering a sale. The first dimension of risk is the balance sheet. Look, you can't go bankrupt if you don't have any debt. So obviously the first most important risk is ensuring a stable balance sheet to where the cash flows of the business can support the debt that the business has. And I'm not against debt. Debt can be a very important tool in order to fund growth investments in the business, whether that's related to money that's being used to acquire new customers, whether it's being used to fund a capital project, it might be used to buy real estate within the business. But ensuring that the balance sheet is not over leveraged and that the cash flows can support the debt on the balance sheet takes away a core risk, or what I call balance sheet risk. The second dimension of risk is ultimately the business model. And the business model is nothing more than your company's ability to add value to your customers' lives in a way that allows them to pick you as their provider of choice. So business model risk is ultimately, can your business continue to generate the same amount of cash flow year after year and also grow that cash flow over time? And there's really two things that can affect that ability to generate those cash flows that leads to business model risk. And that's the competitive dynamics and the long-term, or what I call secular view of the industry. So let's go through the competition. Let's say you have a pest control company that's operating in a tightly defined area, and then a new competitor comes in with huge door-to-door teams that start picking off a lot of your customers. That obviously is going to lead to your retention going down, which ultimately means you have to replace more customers in order to grow, which is likely to drive up your customer acquisition costs. So in that example, it could impact the cash flows of your business due to this competitive threat. There's other long-term threats, and oftentimes these threats are driven by changes in technology. We've seen that time and time again. Amazon coming in and disrupting physical retail is one example. And another technology-driven example that I'm worried about is artificial intelligence coming in and actually disrupting software as a service companies. So as artificial intelligence is able to, create new systems in order to displace these software providers, that could provide a secular or long-term headwind to the software companies. In pest control, lawn and landscape, roofing, and other home services, I think those technological threats are less, but established customer acquisition methods, such as acquiring customers online using Google, that could be disrupted by some of the large language models, such as ChatGPT, Grok, or others in the marketplace. So that's something that I'm keeping an eye on. The third dimension of risk is really you. So management's actions, as I like to say. So management, they can either expand to an area and that was a wise decision based on their analysis of that area, or they could expand to an area that proved to be foolish because they didn't do the work in order to analyze which operating areas they should go into next. Another example would be acquisitions. So if one company is very disciplined in the valuation that they pay for an acquisition, say they're paying 1x sales or 6x EBITDA for an acquisition, but you have another company that's out there acquiring lawn and landscape businesses for 4x sales and 20x EBITDA. Clearly, that creates a substantial risk and is going to lead to less value creation, and in fact, most likely value destruction in the future. So really any decision that the management team makes regards to the cash flow that they've generated and then how they're spending that cash flow to either acquire companies, reinvest in the business, or just take back out for themselves to save, that's going to have a big impact on the overall risk profile of the company based on management's actions. Another core risk is valuation. So if you're an operator, you founded a lawn and landscape company, you founded a roofing company, and you're thinking about like, okay, what are my risks really in operating this business, growing the business, creating value, and then ultimately exiting the business? The big risk on exiting the business is ultimately what other people are willing to pay for that business. And that could be a strategic acquirer, like in pest control, it could be Rent-A-Kill, Rollins, etc. And in other industries, it could be a private equity company across multiple industries, whether that's software, roofing, etc., etc. So thinking about that valuation risk is critical because the market dynamics change and you don't necessarily have control of that. That could be impacted by interest rates. It could be impacted by how much people are actually investing in private equity funds. It could also be, are private equity funds currently being able to actually liquidate or sell their existing holdings? So there's multitude of factors outside of your control, but what you can control when it comes to valuation is the risk of your business. So thinking about this concept of valuation is a risk, but a lot is outside of your control. What's in your control is your ability to consistently generate cash flows that are growing. And if they're growing and they're not volatile, that's viewed as less risky. And then that business is typically valued to a higher degree than something that was very volatile. So valuation is clearly a risk that can be controlled, but a lot of it is also outside of your control. One issue that I also see though during that exit process is really folks going into the exit process without really knowing how much tax they're going to pay on the transaction. And they also don't know what they're actually going to do with the money or how much tax they're going to pay on a recurring basis once they start generating income on their investments. So that is something that we'll take a much closer look at in other videos based on the questions that we're receiving. So those are some of the key high-level dimensions of risk to consider as you operate your business, particularly if you're building towards an exit. And look, some of these risks, they're not in your control, whether that's interest rates or market-based valuations, but many of these risks are within your control, such as how you're orienting your business model and strategy in order to generate consistent and growing cash flows, as well as how much debt you're putting on your business and whether it can sustain it. And lastly, what you're actually doing with the cash your business is generating and how you're investing it wisely in your business or taking more risk that's not backed by high returning projects. So in future videos, we're really going to delve into what to do with your money after the sale, including how to pay less tax, how to invest wisely, and even more so, how to think about whether or not you should sell in the first place. So stay tuned for that. And in the meantime, think about these risk factors and how you can mitigate those in your business, particularly as you build towards a business sale.